Hi class, in this we're going to go over chapter 20 in your textbook, so the economic growth. All right, so one important measurement that many economists look into is the average daily calorie consumption. And if you look at how rich, how poor a country is, you can really tell that by looking at how much the daily calorie consumption is. And then think about, a lot of, especially maybe people in your parents' age or those who are older than you. One of the constant struggle for people in America is always, try to lose weight, try to cut down our calorie. And if you look at the average calorie consumption for people in the country, it does goes hand in hand. So a positive correlation between how rich the country is and how much is the average daily calorie consumption. Now, I'm not saying that individual people that there is a positive correlation between average calorie consumption and how much money they have, because in America the figure tend to be reversed. It tend to be that in America people who are lower income tend to have a higher average daily calorie consumption than people who have a higher income. So the number in America is actually reversed if you look at individually, but as an entire country, when compared to other country, they tend to be the more wealthy the country is, the higher the average daily calorie consumption is. And you have to wonder, why is that? Why is that the more wealthy countries, people consume more calorie? Well, it goes down to how much food can people afford to buy, right? So when we study the concept of economic growth, you can really tell that if a country is improving the economy just by looking at how much the average daily calorie consumption is. Another example you can think about McDonald's. Now, we take it for granted, and we all know that McDonald's is not the healthiest food in the world, but we take McDonald's for granted. I mean, personally, I take it for granted because every time when my 4-year-old want to eat McDonald's, I would take him to buy some, Big Mac, Happy Meal. But when you talk to people in other countries, especially when I was talking to my colleague in Morocco, going to McDonald's is actually a big deal for those kids. So it's only on special occasion when the kids go to McDonald's get a Happy Meal, right? So that consumption of calorie is a big impact or positive correlation between how wealthy the country is. Because in America, we take McDonald's as an everyday normal good, and in many developing countries, lower income countries, the McDonald's Happy Meal tend to be a luxury good, right? So that is a sign of economic prosperity. So when we're looking at the economic growth in human history, for a very long time, the GDP per capita for the people in the countries actually very, very steadily. There isn't that much changes for per personal per capita GDP in different countries, but it all changes in England in about late 1800, so right about 1870, and so we call this period from 1870 onward the modern economic growth. So what happened was that there has been some rapid economic growth in measurement of per capita GDP since 1870. And you're gonna ask yourself, what changed? Why was it possible that since 1870 we saw this rapid economic growth, but before 1870 that just wasn't possible? So it goes down to our industrial revolution. So the widespread use of power-driven machines really made our labors more efficient, more effective to produce more good using less labor resource. So therefore, we're using less people to produce more than we could before. So we don't. So the production for the countries or for the companies doesn't rely on how many workers you hire. Now capital become a big part of our production process. So this industrial revolution was the reason that what kicked off our modern economic growth. And if you look at our industrial revolution also led to some very big gap in inequality among different countries. So between rich and poor countries. So in 1870s, some of the richest country in the world, their GDP per capita is only about 2.4 times of the poorest country in the world. But by 1960, so about 90 years later, that number becomes 4.2 times when comparing the rich countries to the poor countries. All right, so there are two factors that led to this economic growth besides the involvement of our capital. So two things that made this possible. First is our rule of law. So for any economy try to prosper, you have to have very good process, very good rule of law that you can guarantee what is yours. Therefore, we can protect our private properties. So you have an incentive to produce more, earn more, and consume more. And then second is the protection of contractual right. That that it also falls under rule of law. So if you do have a contract with somebody, that this contract can be honored under rule of law. So both conditions here is what made our economic growth possible since the Industrial Revolution. So in order for country to have sustained long-term economic growth, we have to focus on worker productivity. So remember when we talk about this measurement for how good the economy is, which is GDP per capita, looking at how much does each person contribute to the economy, that is basically our worker productivity. So if country can have increase worker productivity, that's a real long-term economic growth. So this labor productivity is the value of what the country's workers can produce per hour worked. And then with our industrial revolution, we do see an increase in labor productivity, and that's because this increasing use of capital in the production. So there's three determinants for our worker productivity. So first is human capital. So that is the knowledge the human workers has to be employed in the position. So basically think about, trainings, schools, education. So those will be all contributing to our human capital. Second is our technology. Now for technology, it's a combination of invention and innovation, right? So it's the advancing technology and also putting those advances into production or services. And lastly is economy scale. That sometimes that you do have a cost advantage when the economy is growing in size. For example, think about, if a country try to educate one, let's say college student. Now, you're going to build a new school. You're going to hire a professor. You're going to build labs. You're going to build, introduce new resources into the school. But if you have one more college student in the same school, the additional cost is very, very low, right? So that's called the economy scale. So sometimes it's cheaper when you try to expand outward. So expand your operation, educating more people, expand your business, and that's also determined for our worker productivity. All right, so two more concepts. So know what's a production function. So production function is the process where firms turns economic input like labors, capital, raw material, technology into output. So input is your resources. Output is the actual production, like goods and services the company can produce. And then in microeconomics, so Econ 2302, production function is described as a firm, so one company's input and output. Now in 2301, macroeconomics, we look at the economy as a bigger picture. So input and output for the entire economy, not just any individual company or individual industry. And I also know what's a aggregate production function. So the process where the economy as a whole turns economic input such as human capital, physical capital, technology into measurement of our GDP per capita. So when we're looking at our aggregate production function, either as a whole for the entire country for GDP, or as a GDP per capita for individual workers, there's a minor difference in the measurement. So for all the input that goes into our overall GDP, looking at four functions or four variables. Number one is our workforce. That's how many workers you have. Number two is the human capital. That is the education, the skill, the knowledge our workforce has. Number three is physical capital. That is the machines, the tools, the equipment the country has to use. And number four is our technology. Now for our GDP per capita, so for the per person GDP, that we're only looking at three variables here. So it's our per person human capital, our per person physical capital, and also our technology per capital. So basically, if you can imagine this, imagine this is the equation here. So we're dividing each side. So because of the close relationship between our worker productivity and also our GDP per capita, that a common measurement to see how productive our US workers are, we're looking at what is the dollar value of productions per hour that workers can contribute to the employer's total output. So for every company, how much is the dollar amount that an additional worker can produce for the company that is measured by the worker productivity. And then one important factor is that for the U.S. worker productivity, we're not looking at farming and we're not looking at our government workers because those two variables are specially measured by the Bureau of Labor Statistics and they tend to have a very unique influence on the economy, or vice versa. The economy has very little influence on the government workers and also farming, but it does has more influence over the private sectors. So for our worker productivity, we do see this continuous increase in worker productivity. So as time goes by, as we employ more technology, more human capital, more physical capital, we do see a higher productivity per capita for workers in America. So in the 1940s, it's only about $20 per hour, but today it's well over $100 per hour. And then if you're breaking down our worker productivity increases by different decades, for 1950 to 1970s, that was the golden era for U.S. economy. So in those years, our worker productivity increased, the growth rate was well over 3% per year. But after 1970s, we do see this slower growth rate in 1990s, and then after 1990s, so for the next 10 years, from 91 to 2000, we do see another high growth rate. But since 2001, we do see another slowdown. One reason why we saw this increasing growth rate in the from the 1991 to 2000, remember that was the internet age. That was the computer, the PC era, where the company's productions using more computers into our manufacturers. That's increasing more physical capital, and that tend to help with our productivity growth rate. So one very important formula you're going to see in this chapter is the measurement of future value. Now, for anybody who knows study, finance, banking, you're going to see this formula very often. But for our econ class, we're going to use this formula here to measure the value of GDP at different growth rate. So the formula is very simple. It just says the GDP at the starting date times 1 plus the growth rate of GDP to the power of years, and then this equals to the GDP at end of the year. So for example, if you have, let's say, a 1% growth rate, we start with $100, and then after 10 years, then you're gonna have $110. But after 25 years, that's 128, and after 50 years, that's gonna be 164. Now, however, if you increase this to only 3%, so just a little higher, you see how the number is increasing faster now, and then way more faster, right? So after 50 years, the number is more than quadrupled, right? So it does increasing way more than 1%, and that's because you had this exponential, right? So your number of years is increasing by exponential, right? So that's the future value formula. So again, it's your GDP at the beginning of the time times 1 plus the growth rate, so whatever the percentage that is, to the power of number of years that will equal to your future value of GDP. So this is all based on the compound growth rate. So you guys probably learned this in your previous classes. So we have the simple interest rate, we have the compounding interest rate. So that's the compound growth rate. That means in the next period, your interest is earning additional interest for you. And as the economy, the whatever additional growth you have for this year, that the next year growth is based on the bigger base. And that's called a compound growth rate. So that's why the economies tend to grow faster with our compound growth rate. All right, so also know what's a physical capital. So that's the plant, equipment, and the firms used in production. So this also include infrastructures. So your internet, your highways, your port, your airport, those will be all part of our physical capital. And also know what's the technology. So all the ways that existed, that input produce more or higher quality, as well as different altogether new product. So these three variable here. So physical capital, human capital, and technology are the key that country can do to increase the productivity for workers. And next, know what's a capital deepening. That's when society increase the level of capital per person. So it's just a process when we're accumulating more capital per worker. And by doing that, by accumulating more physical capital per worker, we're also helping our workers become more productive. So one reason why we saw this prolonged, sustained economic growth in America for the last 50 years is because of capital deepening, that we're investing more and more capitals into our workers in America. So our workers are more productive, we can produce more than everybody else in the world. All right, so if you look at our human capital deepening in America, it is also happening since 1960s. So more and more people are educated than ever before. So today, almost 95% of all new workers in the economy are all high school educated, and also almost 40% of new workers now are now earning a college or even a higher degree, right? So this is an increase of human capital, and that's another reason why our laborers are more productive than other countries. Now, for physical capital, we mentioned this. So we are seeing this capital deepening in America. So in 1950s, we have about 150,000 physical capital per worker, but today the number is almost close to $450,000, right? So I'm pretty sure the number net today is close to $500,000. So we have more and more capitals, physical capitals like equipment, tools, computers for every available worker. Now, if you go to other countries, especially developing country, then we tend to see a very low number for physical capital per worker. So that's why workers in America we have advantage in the production of more capital intensive production because we have more capitals in the country. So for economists, we do have ways to test to evaluate how much is the growth in capital, growth in productivity between different variables. That process is called a growth accounting studies. So we can study just how much impact does the human capital, physical capital, and also technology has on the country's economic growth. Now, for the U.S. economy and also for almost every single economy in the world, we need all three factors present to have prolonged, sustained economic growth. Now, for U.S. economy, technology is about almost half of our overall economic growth. And that's why in the 1990s and 2000s, we see tremendous amount of economic growth because of the expansion of personal computers and internet in the economy. Now, there are things government can do to promote economic growth. So for one, the government can always invest into education, that helping our workers getting more and better educated. That's human capital. We can have more saving investment that will increase our physical capital. We can build better infrastructures, so internet, port, highways, railroad. We can have special economic zones. Now, we don't have that many of them in America, but if you go to many developing countries, they have special economic zones where in certain area, the government tend to have a very reduced amount of tax, try to promote more business startup in the zone, in the area. That's called a special economic zone. And lastly, the government can try to promote more scientific research. And that's one reason why US economy is still leading every other country in the world, because we have the best economic research in the world. All right, so lastly, let's talk about convergence. So convergence, it means that whenever we have countries who are poor and rich, that as time goes by, the poor country tend to catch up to the rich country. So we do see that the countries in terms of economic growth or the GDP per capita, they tend to converge into closer area as time goes by. And this is especially true since the early 1990s, that the growth rate for, if you look at the chart, this chart over here, that since 1990s, we do see a slowdown of our high income countries. We see a faster pace of growth rate for low income countries. So these two group here between high and low income, that because the growth rate is getting wider, but it's in the opposite direction, then we do expect to see that between high and low income countries, they will converge as time goes by. And we do have many examples for that, right? Especially for many of the poor countries, we saw tremendous amount of economic growth in the last 30 years. So think about countries like India, China, Vietnam, Cambodia, so many countries in the Southeast Asian area, and also think about countries like Mexico, right? So for the last 30, 40 years, those economy has been picking up very fast. So the gap between the high income and low income countries are getting smaller and smaller. And one of the reasons why we see this convergence for the last 30 years because low-income countries tend to have advantage when they are trying to achieve greater economic growth than rich countries, than high-income countries. A couple reasons. Number one, something called a diminishing marginal return. It just means that for high-income countries who already have so much human capital, technologies, and then physical capital, by having additional of those capitals make a very small impact in the overall economy productivity because they already have so many computers, educations and technology. But for low income countries, when they start with nothing, just by having a little extra human capitals, physical capitals, technology, actually make a huge difference in the country's productivity. So for example, imagine if, let's say we take a rich country like America, if let's say 2022, we're going to increase our overall educated worker by 1 million people. So 1 million additional college educated workers in America. That's good, but that impact is not going to be as big as if this 1 million people go to a poor country. Let's say if the 1 million people move to Zimbabwe, and that's going to make a huge difference because they start with nothing, right? So that's called a diminishing marginal return. That's something, if you already have it, the additional amount you have, you can have a smaller return as you have, right? So you have a smaller benefit as the more stuff you have. Another similar concept of diminishing marginal return, that's something you learn in your supply demand chapter. It's called a diminishing marginal benefit, right? So same thing as a diminishing marginal return. So the more of something you have, the less benefit you get from each additional unit. And next, it's easier for a low-income country to apply new technology, and that's because technology was already invented by high-income countries, right? Think about internet. So internet was invented in America, in Europe. So even though at the first European countries and the US, we enjoy the benefit for internet, but now many of the low-income countries, they also enjoy the benefit for internet without having investing into the innovation and establishment of internet in the country. And then lastly, that low-income countries can observe the experiences of high-income country. So learn from the high-income country, see what works, see what didn't work, and then learn from those experiences. So those are the advantage that low-income country has over high-income country when they try to catch up in terms of economic growth. And all three of these are made it possible in the last 30 years because of the widespread use of information, so internet, and also globalization, which means the freely flow of capitals, resources, and technology. So one way for a country to reduce the impact of diminishing marginal return is to introduce more technology, because diminishing marginal return will impact our human capital and will impact our physical capital, but has no impact on technology. So if the country can and able to continuously innovating with better technologies, then we can go around the impact of this diminishing marginal product. So if you illustrate this on our production function. So every time we have a better technology, you see our production function line here, the blue line, with a better technology is able to shifting higher, higher, and higher, right? So that's how we get around this diminishing marginal return in the country. So technology is improving the productivity without diminishing marginal return. Now, lastly, to demonstrate the slowness of convergence, so the concept of high income country and low income country with different growth rate tend to converge eventually. So imagine we have a high income country with a $40,000 income at a 2% per year. After 30 years, they will end up with $72,450 per person. But for a poor country who start with only $4,000 a year. Now, at the very beginning, we compare between 40,000 to 4,000. That's a difference of 10 times. But with a 7% growth rate, so a little bit faster than the rich country, then after 30 years, the poor country will have a total about 30,450. So now the difference is just a little over 2 times. And so we see the two numbers here are converging as time goes by, right? So that's the idea of convergence. All right, guys, so that's it for this chapter. So if I have any question, let me know, and I will see you guys for next chapter. Bye-bye.